Good morning. Welcome to Finance Class Online. Kind of a fun, interesting new development. So I'll be posting these periodically, and our class process won't be that different, really. Instead of me lecturing in front of the room, I'll lecture here, and then we'll work problems just kind of like we normally would. I just won't be in the immediate vicinity to Copilot, but I'll work through some examples on video, and hopefully you can reference those to keep it going. So our new topic for this coming 2 weeks is going to be bond pricing. So bonds are actually a really important part of the economy. They come up a lot. It's, in short, securitized debt. So if I'm a corporation and I want to borrow $10 million, I break that loan up into $1,000 chunks and then sell them off to investors. So they purchase a certificate that says I'm entitled to $1,000 at some point in the future, and interest rates along the way. That's how these normally function. As you can see here, I have posted to the screen here. I have the daily treasury rates. You can see here this is over a lot of different frequencies. So when I say treasury rates, these are loans to the federal government, but securitized as bonds. And there's lots of different time horizons over which people can lend to the federal government. So you've got 1 month horizon, 1 year horizon, 30-year horizon, lots of different ones. And as you can imagine, the longer the loan is, right, the longer you're lending loan to the government, the riskier it is for a couple reasons. So first, you don't know what the financial situation of the federal government is going to be in 30 years, but you know pretty well what it will be in a month. So there's a lot more uncertainty around the longer horizon ones. So that's part of it. But also a big factor, even bigger factor actually, is that when you have money that's so far in the future, we know from our time value of money calculations that that money far in the future gets affected a lot by interest rates, right? If your interest rate is high, the money is worthless. If the interest rate is low, it could be worth a lot still. And so the value of the cash streams 5, 10, 15, 20 years out are very strongly affected by interest rates, which means the prices move a lot when interest rates move, which makes them riskier. And so in general, you would think you'd want to be paid a risk premium to own 30-year debt. So here's something that you can sort of see how interesting things got. So if I look back at March 2nd, if I want to lend money to the federal government for a month, I would get 1.41% per year. So not a lot, but some. Right? And I mean, historically, if we went 7 years-ish with that number basically zero. So the fact that you can get anything for lending to the federal government for the month is, it wasn't true for a long time. And as you can see, this is pretty flat. In fact, this was sort of kind of a period of unusualness here in that we have the medium-term stuff is actually worse for returns than the short stuff. So that's a little unusual. And the long-term things are still really good. But look what a difference a week makes. So this is back in March 2nd. So if you go to March 9th, a week later, I could have earned 1.41% lending to the government for a month. By March 9th, I was getting less than 1% for lending for 30 years. Right, interest rates had fallen all the way across the board. You can see they're teeny tiny for 3-year and 5-year loans. I guess that's a different date, but right, this is very small, right? Teeny tiny for 3 and 5-year loans, 0.5%. This is obviously very unusual. So what's happening here? Well, if you think about how a traded bond would work, if let's say I have a $1,000 loan that pays a 10% interest rate, that would mean that $1,000 of lending would pay out $100 every year, right? That's that 10% working. Now, suppose interest rates fall. Well, now that bond might be worth $2,000, right? If it's paying a really good rate, people will want it and they'll pay more for it. So you might pay $2,000 for that bond. At $2,000, now that bond only pays 5%, right? Because you put $2,000 in and you get $100 out, that's 5%, right? The $100 doesn't change. That's written specifically on the contract. We actually, it's called the coupon rate because there were little paper coupons you clipped off the bottom of the certificates in the old days, right? In the 1800s. And so those bonds have are trading at much higher prices, and why? So if you think about supply and demand in economics, why are bonds, right, for prices to be high? It's either the supply was low, which isn't really true. There's a little bit to that, but more that the demand was really high. So why suddenly on March 9th was everybody demanding bonds like crazy? And the reality is, it's right. So COVID happened, and everybody wanted out of the stock market, right, as fast as they could get, and they wanted to find the safest thing they could find because the market is, on fire, burning down. And so the safest thing on planet Earth, as far as everybody can tell, for the most part, is to buy U.S. government debt. Now, there are people who put gold in their basement or buy canned food or toilet paper, but for most sophisticated investors, the safest place they go is U.S. government debt. And so you have a huge influx into government debt driving up prices. And then things drift later after that. But you can see, right, that we can see the stress in the markets right here in the Treasury curve. So bond prices reflect that. It's also very important from a managerial context because if you're a manager of a company looking to raise money, you can issue bonds, do bond origination, and generate cash to do your activities, right? Tesla issues bonds, Google has bonds, Apple has bonds, right? Corporations use bonds to raise money. In fact, the city governments, state governments use bonds to raise money. Even like a local church might use church bonds sold to the parishioners to like build an addition or a children's ministry or something, right? This type of security is used all over the economy. Convertible bonds are used extensively in startup financing for new ventures. So understanding how bonds are priced is actually pretty important if you're going to be a manager that is at some point in a position of needing to raise money. I had a student who was in a master's program I taught in Arizona that actually did bond origination full time for their career. Because again, if you continually need to raise, you have to do a new issue. You have to figure out what interest rate, how to price them, what restrictions to put on them. So he just full time was creating new bonds for his employer, selling them, and just did it on a rotating basis. So we're interested in what bonds are trading for. And the nice thing about bonds is the cash flows, other than default, are steady. They're consistent. And so, in the previous example, if we're getting $100 every year, that's consistent. It'll be $100 every year until we get our $1,000 back. And so since the cash flows are very predictable, it works very nicely with the financial calculator. In fact, the financial calculator was designed... the exact design of the financial calculator is to facilitate the rapid pricing of bonds on a trading floor. And so we'll feel very much at home on the financial calculator when we find these bond prices because that's really what it was made to do. So we're going to hop over to the bonds in class, right, and take a look at this assignment, and I will work through some examples of pricing some bonds using the financial calculator. So go ahead and open that up. I'm going to end the video. We'll start a new segment and we'll work through some problems.